Hello everyone, we are from Group 9 and we will be explaining the case study of Innate LTD. Here are members of Group 9. I'm Kashmini Kesavan together with Lavinash, Navarenta, Sharwanti, Shangshinyun, and Roshana.
Hi, my name is Navenda Subramaniam. I would like to explain about the case summary. Any LTD design and manufacturing bespoke light fitting for the hotels and restaurant revenue is recognized when the finished light are dispatched to the customer and customer are given the 30 days credit. During the 2025, any product become very fashionable and leading to the rapid growth in commission and a significant increase in revenue compared to the prior year. The rapid expansion has been direct impact to the both trade receivable and trade payable, which are key area of the audit risk. Trade receivable increased substantially during the year. As production can take several months, there is a timing gap between the commission and invoicing. In addition, quality issues with material sourced from a new supplier had led to customer complaints. This increased the risk of dispatch invoice and delayed payment and a potentially irrecoverable receivable. Trade payable also increased due to several new overseas supplies. Supplies invoicing in a foreign currency, adding complexity to the recording payable. Internal control weaknesses were identified, particularly the failure to retain a reconciled supplier statement, which increased the risk that trade payable may be complete or inaccurately recorded. There are also a wider internal control concern. In some cases, metal are ordered and production began before written customer approval was obtained. IT controls over the design software are weak, and there are compliance issues relating to the factory worker safety. Finally, ENIT acquired 100% Nevermore Ltd in June 2025, meaning this is the first year of group financial statement. Another audit firm will audit a subsidiary and increasing audit complexity and coordination requirement. Overall, rapid growth and internal control weakness and first year gap reporting significantly increase the audit risk, and particularly in the relation of the trade receivable and trade payable.
I'll explain the first question of the case study. Benefits of using analytical procedure at the planning stage. Identify unusual movement in trade receivable. The significant increase in trade receivable, which is unreasonable to the revenue growth. Analytical procedure helps to identify the potential risk of overstated receivable. Second, evaluating trade payables completeness. Review of trade payables shows a slight increase despite a huge increase in cost of sales. Third, assessing revenue recognitions risk. Comparing revenue growth, which increased by 47%, with receivable, where it increased over 100%. Limitation of using analytical procedure at the planning stage. First, reliance on draft financial information. The analytical procedures may contain errors or management bias which reduce the reliability. Second, rapid business growth reduce comparability of current and prior year figures, which limits the effectiveness of analysis trends. Third, fail to detect all misstatements or fraud, where misstatements involving customers with a large balance or specific unrecorded supplier invoice may have a minor effect in overall trends. We will explain the second question of the case study. Larissa wins. First, competence, professional, and due care. The firm should examine if Larissa has appropriate qualification and experience. Since there's no information provided about her professional history, the auditor may not able to judge the accuracy of her work. Second, objectivity. She was appointed by the finance director, which could affect her objectivity, where may arise risks when she make a conclusion on the effectiveness of control. Third, scope and relevance of the work performed. Larissa work focused on internal control over purchasing and production. Her work cannot be utilized to reduce the audit procedures. Fourth, completeness of documentation. Larissa left without finish her final report, indicating that her work may be incomplete or not recorded properly.
Now I will move on to the PAPI, which is a matter to consider when using the work of Deng Hai LLP as a component auditor. Firstly, the firm should consider whether Deng Hai LLP is willing to cooperate with a group auditor, including allowing the group engagement team to be involved in this work and complying with the instruction issue at the group level. Secondly, annex and independence complaints must be assessed to ensure that its audit work can be relied upon for group audit purpose. Thirdly, the firm should evaluate whether the Deng Hai LLP has sufficiency professional competence, experience, and technical advantage to audit Nevermore Ltd. In addition, the professional reputation of Deng Hai LLP and any overall dealing should be considered to determine whether relying on its work is suitable. Finally, the significance of Nevermore Ltd should be assessed as it affects the extent of reliance placed on Ltd and the level of group auditor involvement required. Now we will be moving to the requirements 3, where we will focus on the consequence that for each internal control. For part A, which explains the consequence when supplier statements are not retained or reconciled with a payable ledger. Firstly, underpayment or late payment of supplier may occur. This can result in the loss of promote payment discount as well as interest charge or penalty imposed by supplier, which will increase the company's cost unnecessarily. Secondly, overpayments or duplicate payment may arise when errors in the payable ledger are not identified. The company may make unnecessary cash outflow leading to poor cash flow management. Thirdly, poor payment practice may damage supplier relationship. As a result, supplier may impose stricter credit terms, suspend delivery, or even stop supplying material to any LTD. These issues show how weakness in supplier statement resolution can directly affect both cash management and supplier confidence. Fourthly, disruption in supply of material may cause delay in receiving materials, which can delay production and customer order fulfillment. This may lead to reputation damage or cancelled customer orders. Fifth, there is an increased risk of errors and fault. Without supplier statement cancellation, errors or fraudulent activity may not be detected on time basis, increasing the risk of financial misstatement. Finally, all of these issues may have a negative impact on any LTD cash flow and profitability. Higher costs, operational delays, and weakness control can advise affect the company's overall business operations. In conclusion, failing to return and conceal supplier statements exposes the company to significant financial and operational risks.
Now we will look at the consequences if the company does not regularly update their antivirus software. Firstly, it increases the risk of unauthorized access or loss of important data. This is because the company will be exposed to malware and virus attacks through hacking, and this will cause the company to lose important confidential information such as customer details, customer designs, sales invoice, purchase invoices, and pricing information. Secondly, it causes an inaccurate or incomplete accounting information. Any loss of data will cause an increase in the risk of material misstatements. For example, a loss of a sales invoice will cause a misstatement in the revenue account balances due to an incorrect revenue recognition. And lastly, it may cause an interruption in the company's daily business activities. Cyber attacks may result in interruption to business activities, causing a delay in daily operations, productions, and dispatch of their light fittings. This is because a system breakdown may cause a difficulty for the staff of Enix Limited to access the customer's design files, which leads to a delayed invoicing, cash flow issues, and also increased trade receivables. Next, we look at the consequences if Enix Limited orders their metals and also start their work before a proper written approval of the design and price of the light fittings from the customer. Firstly, it causes a dispute due to a design specification or also the pricing. Starting the production before the approval of the design and price from the customer may cause dispute because there is no formal evidence of the customer's agreement. So, there's a high risk that the Enix Limited may construct the light fitting of the design and materials which are not as per the request of the customer. This will result the customer to not pay for the lights fitting because they disagree on the pricing, and in the end they refuse to receive the product, which can increase a risk of bad debts. Secondly, it may cause an incorrect revenue recognition. The revenue may be recognized for commissions from customers which are not contractually agreed, and in the end, it will cause an overstatement in the revenue of the financial statements of Enix Limited. Lastly, without a proper contractual agreement, the company may make unnecessary purchases from suppliers. As Enix Limited has foreign suppliers, buying metals and starting production before a customer approval may cause foreign exchange loss and unrecoverable costs. If the customer suddenly cancels or disputes the order, the metal and the work in process may not be repurposed, resulting a redundant inventory and a irrecoverable production cost.
Now I'll explain the part D, protective clothing not provided to employees when handling the metalworks. And the first consequences is health and safety risk will increase. Employees who are handling metalworks without protective clothing are exposed to cuts, burns, and other serious injuries. This may increase the probability of workplace accidents, which may disrupt the production activities. The second one is breach of legal and regulatory requirements. Fail to provide protective clothing are represent non-compliance with occupational health and safety legislation, and in it may subject to fine, penalties, or enforcement actions by regulatory authorities. The third one is financial consequences. Since there is no protective clothing, there might have accident happen. So the injured employees may seek for compensation or file legal claims against Init. And the last one is operational disruption and reputation damage. If serious accident happens, it may lead to temporary shutdown of factory operations, which could delay in production and delivery of light fittings to their customers. And also, poor employees' welfare practices may harm Init Ltd's reputation, which could affect the relationship with their customers. Now, we will explain the question 4 of the case study. Now, I'll explain the part A of question 4, trade receivables. So, trade receivable represent a key audit risk due to significant increase in the year-end balances, rising from £451,000 in 2024 to £980,000 in 2025. So, this increase is substantial and may indicate that amounts are not being collected within 30-day credit period and increasing risk of overstatement. And the next one is revenue recognition and cut-off risk. Init recognized revenue only when light fittings are dispatched, often several months after the customer's commission. And this creates a cut-off risk as revenue and trade receivable may recognize before dispatch, resulting in premature recognition. And the third one is customer disputes due to quality issue. So Init has experienced quality issues with metal sources from new suppliers, which lead to customer complaints. So customer may withhold payment or dispute invoices, increasing the risk of trade receivable will not be recoverable. And the last one is there is a lack of written customer approval. So this raises the risk of Init does not have valid contractual basis to recover the amount invoiced, further increasing the risk of irrecoverable receivables. So these are the audit procedures for trade receivable. So the first one is the auditor has to perform direct confirmation with the customers. Second one is they have to review the aged receivable analysis. Third one is they have to inspect post-year end cash receipts. And fourth one is they have to inspect the post-year end credit notes. And the fifth one is they have to find whether any overdue or disputes balances have written customer approval or any related commission involved metal sourced from the suppliers with known quality issue. And the last one is they have to evaluate the basis of the allowance for expected credit losses.
I'll be explaining about trade payables. Trade payables have been identified as a key audit risk due to the rapid growth in Init Ltd's operation during the year. Trade payables increased from £483,000 in 2024 to £571,000 in 2025, in line with the significant increase in revenue from £6.1 million to almost £9 million. This higher level of purchasing increased the risk of errors in recording suppliers' invoices. In addition to Init's purchasing metals from overseas supplier who invoice in foreign currencies, creating a risk of misstatement in incorrect exchange rate applied at the year end. The company also engaged in several new suppliers during the year, and internal controls are weak because of the supplier statement are not reconciled. This increases the risk of incomplete or unrecorded liabilities. Therefore, the liabilities represent a significant audit risk, requiring focused audit attention. Next is audit procedures. First is supplier statement reconciliation. Obtain the supplier statement and reconcile them with to the trade payables ledger to identify any missing or unrecorded liabilities. Second is to search for the unrecorded liabilities, review the payments made after the year end, and trace them to support the invoice and goods received. Third is a foreign currency translation testing, recalculating selected foreign currencies payable using the year-end exchange rate. Fourth is cutoff testing, inspecting goods received and suppliers invoice around the year end, ensure the payables and are recorded in the correct accounting period. Fifth is suppliers confirmation, send the confirmation to major or new suppliers to verify the outstanding balance. And six would be the review of purchasing control, evaluate the control over the purchasing and invoice approval, especially for the new suppliers, and increase the substantive testing. Now I'll be explaining about the question 5. Key matters to discuss with the junior auditors. Explain the Init Ltd's business operation and the key audit risk identified, particularly related to trade receivable and also trade payables. Secondly, we'll be highlighting the internal control weakness identified and how this increases the risk of material misstatement.
Levinash, I would like to continue from Ravilash. Audit objective and procedure must be clearly explained. Junior should understand the purpose of each audit procedure and specific audit assertion being tested, such as the competencies, accuracy, existence, valuation, and cutoff. This, secondly, the importance of professional skepticism. The judgment should be emphasized. Junior auditor must maintain a cautioning mindset and remain alert to unusual transaction, missing or inconsistent documentation, and explain that to align with the evidence. Finally, clear guidance on documentation and communication is essential. Juniors should be instructed on how to properly document the audit work, evidence obtained in exception, identified, and conclusion are reached. They should be also understand escalation procedure, ensuring that any significant issues, control weakness, or potential misstatement are such promptly report to the senior member of the audit team.
That's all from us. Thank you.